Hello friends, today we are going to talk about the risks involved in while investing in stock market. Now, I just want to recount you one story that I experienced recently at an investor training on future and options in Jaipur. I found this person came up to me during lunch, and he lost. He was a retail investor, and he lost close to 10 lakhs in future and options in the stock market, and now he was almost in his tears. And he was ruining that he did not meet someone like me who can tell him about the risk. Like, he was not at all aware of all those risks that I had spoken about in the first half. Now, this is exactly the problem all over India. This problem is basically there because the broker is only interested in his commission. The broker has appointed the relationship managers just to and link their salaries to the commissions they earn for the company, and all the relationship managers do is to catch hold of investors like you and me, and show them big dreams of creating wealth, of earning 20%, 30%, 50%, 100%, and they just are interested in their own commissions. Remember how a broker earns. The more he churns your portfolio, the more he earns. The more he tells you to buy and sell, the more he earns. So you should, as an investor, you should be aware about the risks involved in investing in stock market. Now, there are primarily two types of risk. The first risk is systematic risk, or it is also called systemic risk. The first is systemic risk, and the second one is unsystemic risk. Now, the systemic risks are risks which cannot be wished away. You cannot throw them out. They will be there in the system throughout. What are the examples of systemic risk? For example, inflation. Now, inflation today, as we speak, is the single most problem that India is facing. Now, that is a risk for all. If a corporate, the big Ambanis and Tatas and the Birlas, if they want to take loan, the loan they are going to get is on a higher rate of interest. So inflation will affect them. It will affect their profitability. A person like you and me, when we go to market to buy things for us and our family, food, vegetables, petrol, all these things, inflation makes them more expensive. So, if our salary or our income is not matching the inflation, which is growing at more than 10%, and the actual inflation is more when you see the vegetables, the food items, and the petrol and all that, which affects us directly, it might be growing at a faster rate. So that is a systemic risk. Those risks are called systemic risk. Now, how to protect ourselves from systemic risk? Systemic risk, frankly speaking, you cannot protect, you cannot escape. The only thing is that you can transfer that risk. That risk has to eat someone. He has to kill someone. Now, whom does it kill? It is coming to you, you transfer it. It will not hit you. This thing in finance is called hedging. Now, long time back, how this hedging and this transfer of risk came, I'll give you a small example where this farmer was there long time back and he was producing all these rice, quintals of rice from his hectares of land. And suppose at that time one quintal of rice was the price, the market price at that time was 100 rupees. Now, we're talking about a time when the rice is still not up, it's still there on the field, and it will take 2 months for it to come to the market. Now, today the price is 100 rupees per quintal for the farmer. Now, what is the risk to the farmer? Yes, the risk to the farmer is that the 100 rupee he is getting right now will go to say 80 rupees, 70 rupees or 60 rupees. It can go down. That is the risk for him. Now, how does he protect, or how does he transfer his risk? Now, what he will do is he will catch hold of a trader. Now, trader, there are different kind of traders. There are traders have their own doing the business. There are traders who are positive about the market. There are traders who are negative about the market. The market runs only when there are positive and negative people. So he will catch hold of a trader who is positive about rice, and he thinks that this trader thinks that the price of the per quintal of the rice will go up to say 120, 130, 150. He is bullish about it. Now, this farmer, what he will do is that he will enter into an agreement with the trader and say that, okay, the price is 100 rupees. I do with you a deal for 90 rupees. Okay, so on 90 rupees per quintal, you take my stock. Now, this trader does that, enter into that agreement. Now, tomorrow, if the price goes up, it is a profit for the trader. If the price goes down below 90, it is a loss for the trader. But the farmer has transferred his risk of, and he has contained his risk, and by entering into agreement with the trader. The same thing can be done in the stock market. If you have a portfolio which has appreciated quite enough, there is a tool called hedging via futures and options in stock market, where you can transfer that risk. So all the systemic risk can be transferred. They cannot be wished away. They will be there. And if you are a smart investor, you will use those hedging techniques in future and options to protect your portfolio and grow your wealth. Hedging and options techniques were primarily designed to do this. They were not designed to speculate, which has become a norm today, thanks to our all thousands and lakhs of sub-brokers and brokers. So now let's go to the unsystemic risk. Now unsystemic risk, you can contain the unsystemic risk by diversifying your portfolio. For example, unsystemic risk, let me give you the examples of unsystemic risk. Unsystemic risks are the risks which affect a particular company. For example, unsystemic risks like strike in a company. Now, strike in a company is it affects that particular company. So that is an unsystemic risk. Now, if the government it stops exports of rice or exports of sugar due to some reason, so that affects those rice producing or rice processing or export those sugar export companies. So they affect the individual companies. So that is unsystemic risk. Now unsystemic risk can be contained. They can be you can manage your unsystemic risk by diversifying your portfolio. Don't invest in only one sector. Don't invest in only within a sector. Don't invest in only one company. Spread out your suppose you want to invest 1 lakh, spread it out in different sectors, and within different sectors different companies. So this will protect your the unsystemic risk. I'll give you an example where this Satyam thing was there 3 years back. If you had invested and you were bullish in for the IT sector, and you had put all your money in Satyam, it would have gone. Now, but if you were bullish for IT sector at that time, and if you had put your money in, say, Infosys, in, say, Wipro, in, say, Satyam, and few other companies, TCS and all that, then a Satyam Picasso would not have affected you much. If your portfolio has gone down considerably on Satyam, it would have those Infosys and Wipros and TCS would have given you a cushion and would have not affected your portfolio that much. So that is a risk management for you as an investor. I hope you have got some idea about how to protect yourself while investing in stock market. There are advanced strategies and tools, as I told you, hedging and future hedging, the use in future and options, and there are strategies to diversify your portfolio, which will be a topic of discussion, and you will see further videos on that. And I hope this session gives you a certain basic minimum knowledge about risk and how you can protect your portfolio. Thank you very much.